Have you ever dreamed of building a second home or a vacation home for you and your family? Well, this is something that Drew and I particularly specialize in, is helping people build their vacation homes. We primarily land on the Outer Banks, North Carolina, which is a coastal barrier island. And most of the properties we finance when it comes to new construction are second homes. And we often finance, probably 20 or 30 new construction client builds every year. So it's something that we feel like we specialize in, and Drew has an even longer history in it. He's almost got,
37 years in the mortgage
37 years in the mortgage industry. And, just to go a little bit further, if you know the area well, we've helped people build houses even on a small island of Ocracoke, for example, which is you can only get to by ferry, which is a super cool vacation spot. And all the way to the other side, if you go north, all the way to almost Virginia and Corova, we've helped people finance vacation homes up there where there's wild horses and just really scenic beaches with a ton of space. If you haven't gone to Corova, it is awesome, and it's such a cool spot, and also a great rental income opportunity if you're an investor. But just to talk about construction lending a little bit, I'm going to have Drew kind of give his background in it because it all starts back in the 80s, and so he can give his kind of take on it for years and years, or really decades of experience.
So, when I got into banking, I wasn't a mortgage banker from the beginning. I worked in the bank, and I was a teller at one time. I repossessed cars even. But it's sort of like the guy who flipped couches. So anyway, when I came to the Outer Banks, I got a call to work for today what is Bank of America. Back then it was called North Carolina National Bank. It became Nations Bank, and then later it became Bank of America. And they wanted to open a bank branch. And the first thing they said was, we're gonna hire you. You're like our test person out here to see if it works. We need to make lots of loans. If we get so many millions of dollars in loans, then they'll earn interest and they'll help pay for our branch. Back then that was the way banking worked. Sort of like the old.
But you weren't a mortgage lender.
I was not a mortgage lender. Didn't know anything about mortgage lending. I knew a little bit about commercial lending. They were great mentors for me and did help train me a lot to get trained to make loans at this company, NCNB. And so they had actually developed some relationships with some mortgage brokers, and they were like mortgage lenders, and then that fell into more traditional mortgage lenders that were on the beach helping people buy and build homes. But none of the mortgage lenders had construction financing. They didn't have it. They just like, we'll give you a mortgage when the house is finished, but you got to go get a mortgage from somebody to build it. And at the time, there was one small bank down here doing it. They had all the business, and so they were doing the construction loans. And it seemed like, well, if only one bank's doing it, we just undercut them a little bit, we could pick up a lot of business. And plus we'll do super fast, we're busy closing, and everybody, the realtors and builders would love us. So we started talking to mortgage lenders and doing construction loans in the bank's commercial portfolio. And it would be this loan over here, and then we knew we would get paid out by this mortgage company when the house was finished 6 or 7 months later.
So how'd that process work for someone to get did they get 2 mortgages?
Yeah, they got to get a construction loan. Well, first actually, they go to the mortgage lender, they get all ready and get approved, so to speak, and they go, well, by the way, we don't really do the construction loan. We're going to send you over here to Drew and let him do the construction loan for you, and then you're going to come back to us, update your file and give us some more information, and you're going to close again. So Mike Casey, the attorney that we use today so much, or other attorney, Starkey Sharp or whoever, would get to close twice. You get to go see Mike or Starkey twice, not just one time. Well, Mike and Starkey are not free.
Well, that sounds great for the attorney.
It was also great for the bank. The bank was like, okay, well, we'll make a fee on this loan.
Right, they'll make interest on that loan.
Right, we'll make interest, we'll charge a fee, and then you'll come back over here, and then they'll make the fee. It just seemed like to me, as I studied this more and more after doing it until from 88 to 92, I was like, there's really got to be a better way to do this for the consumer. This is just not that great for them. Yeah. And during this time period, my company came NCNB, became Nations Bank, and they started a mortgage company. And while they did that, they said, well, let's create a one-time closed construction perm program. And the banks were flush with depositors' money back in this era. not a little bit like it is today. And so they were like really wanting to use this deposit-based money to do some portfolio lending, and the construction perm program was a good idea. They put it inside the mortgage company they created, and they said, let's have a one-time closed construction perm program. And I was like, oh man, this is gonna be awesome. This is what I should do. I should get out of the bank and go into mortgage, because I think I could do a few mortgages and be successful this way.
So one-time close, meaning that you don't have to go see the attorney twice, which that would obviously save money, right? If you don't have to settle with
It's the entire
twice.
way of how I got into the whole way I got into the mortgage business was by construction lending. It wasn't through any other idea. It was just learning it through this process and then thinking I could be successful with it. And what I also found is no bank hardly has construction loans. Nobody has it.
It's still
It's a niche product.
Still today, most people, or a lot of banks or lenders don't have like
Yeah, Bank of America got out of it after the financial crisis. One reason I don't work there today. If I'm going to live and work in the outer banks, I think I should live in here to support my community. We're not a community that has big time builders. Our builders build anywhere from 2 to 3 houses a year, to 5 to 7 or 10, to maybe as many as 30. That's it. And so when you don't have a construction perm product in your arsenal as a mortgage lender, to me, you're just not serving your community. And I really wanted to always have a construction perm program to serve my community.
Right. So let's talk a little bit about the program itself and how, if you were a borrower, how would the program work? There's certain criteria, of course, for any loan that you're looking at, whether that's a purchase or construction. But focusing on construction loans, when it's a one-time close, it's classified as a portfolio loan. And that means that this loan is held on the bank's books. Like Drew was talking about at Bank of America, they wanted these deposits. They were flush with deposits, which means if a bank is flush with deposits, they want to lend their own money. And so that program where they offered a one-time close is a portfolio product where they aren't selling that loan, they're holding that loan on their books. And this is something that we offer, of course, where we work at First Heritage Mortgage. We offer a program that is a one-time close where an investor or lender is going to hold that loan on their books. And some of the criteria that we're looking for is very similar as if you were going to buy a home, but just to kind of go through it, it would be, your credit score, just like buying a home. It would be your assets. So, for example, your assets for a construction loan are a little bit different than a purchase. Purchase, you just need to know basically, for the most part, what is your total cash money needed at closing. Maybe you might need a payment or two to show that if something were to go wrong, you could make a payment, which is what Drew's talking about, is reserves. But for construction loans, it's a little bit different. One, you gotta think, when they give you a loan, there's no house there, so there's no collateral. What if you don't make a payment and the house isn't completed? So they want to make sure that if there's, in the middle of construction, this borrower is a little more qualified or has a little more cash on hand than just 1 or 2 payments. So talk a little bit about that, Drew, about how reserves or additional cash are needed for portfolio loans.
So construction loans, generally speaking, require a little bit more reserve. Like I said, most purchases say you want 2 months reserves. That's of the proposed payment. So the payment's $3,000. They want 2 of those. That's $6,000 of reserve. Pretty low reserve requirement in most cases for somebody who's especially putting 20% down. A construction loan is pretty typical to see banks want reserves to be as much as 10% of the cost to build. So if your cost to build is $1 million, 10% of that's $100,000. Now you got to have $100,000 in reserves, and they have a payment reserve that's typically more than just 2 months. It might be 6 months. So if your payment's going to be $5,000, that's 5 times 6. That's another $30,000. So now you have $130,000 in reserves. For a primary residence, that could be a stretch because you may not have extra money. If you're buying a second home, you're typically more qualified. You might have it, but you may not. Now reserves can be cash, they can be stocks, they can be a retirement account, but some of it does